What's up, future Filipino CPAs? Welcome to an explainer that's going to feel like a cheat code for your financial accounting and reporting subject. We're diving deep into prior period errors, and I promise you, by the time we're done, you're going to totally master this topic for the LECPA. Okay, just imagine this for a second. You're fresh on the job, maybe a first-year auditor, and bam, you find a huge mistake in the financial statements that were already published last year. Your heart just drops, right? Well, don't sweat it. There's literally a playbook for this exact situation, and today we're going to learn it inside and out. All right, so here's our roadmap. First, we'll figure out what a prior period error actually is. Then we'll crack open the official rulebook, Pass 8. After that, we'll get into the two main types of errors you need to spot. Then, the fun part, the step-by-step fix. We'll see how one tiny error can cause a massive ripple effect, and then we'll wrap it all up with a super fast bullet review for exam day. Let's do this. First things first, let's put on our accounting detective hats. What exactly is this thing we call a prior period error? Because, it's way more than just a little typo. So this is the official definition right here. But the part you've got to lock in your brain is this: failure to use or misuse of reliable information. What does that mean? It means the right info was there. It was available when the first reports were made, but somebody either missed it or used it wrong. So this isn't about having a crystal ball. It's about correctly recording what already happened. So who are the usual suspects here? Well, it can be something as simple as a math error, calculator fumble, or maybe misapplying an accounting policy, or misreading the fine print on a contract. And of course, the classic, just plain forgetting to do something, like an adjusting entry for an accrued expense. These are the exact kinds of things that love to pop up on exams. Okay, so every detective needs their rule book, right? For us accountants in the Philippines, when it comes to fixing mistakes of the past, our absolute go-to guide is Philippine Accounting Standard 8, or Pass 8. This is the law of the land on this topic. Yep, PAS 8 is the whole shebang. It covers accounting policies, changes in accounting estimates, and our star for today, errors. This standard tells us precisely how to clean up the mess. Honestly, just remembering that PAS 8 is the one for prior period errors, that's a free point on the LECPA right there. Now, this is where it gets really interesting. See, not all mistakes are the same. Your very first move when you find an error is to figure out what kind of error you're looking at. And trust me, this is super important because it totally changes how you'll handle it. Let's break down the two suspects. On one side, you have counterbalancing errors. I love the analogy here. It's like a fever that breaks on its own. These are mistakes that, even if you do nothing, will automatically reverse themselves out in the next year. On the other side, you've got the really annoying ones, non-counterbalancing errors. These are like a permanent marker stain. They will mess up your books forever and ever until you get in there and manually scrub it out. So what does a self-correcting error look like? Well, say you forget to record accrued salaries in year 1. Okay, so your expenses are too low and your profit is too high for year 1. But what happens in year 2? You'll pay and expense those salaries, making year 2's profit too low. So over the 2 years, the effect on your total retained earnings, it just washes out. It fixes itself. Now for that permanent stain. The classic LECPA example is when you buy a big machine and expense it immediately instead of capitalizing it as an asset. Whoops. Your profit in year 1 is now way too low. But it doesn't stop there. Because it's not on the books as an asset, you won't record any depreciation in years 2, 3, 4, or 5. So your profit in all those future years will be too high. See, this error just keeps on messing things up. All right, we've found the error, we've identified its type. Now for the main event. How do we actually perform the accounting time travel to fix it? This is the procedure you absolutely have to know cold. Pay close attention, because this is the money shot right here. It's a 4-step process. 1, find the mistake. 2, calculate how much it messed things up, and I can't say this enough, it has to be net of tax. Always, always, always net of tax. 3, the big adjustment doesn't touch this year's profit. No, it goes directly to the beginning balance of your retained earnings. And 4, you got to go back and fix the old financial statements you show for comparison. This whole thing is called retrospective restatement. You are literally going back in time and making the books look the way they should have looked from the start. It's like a giant CTRL plus Z for accountants. The whole point is to make sure your financial statements are actually comparable year over year. Okay, so for the LECPA, just knowing how to make the journal entry, that's beginner level.
The really tricky questions, the ones that separate the passers from the top-notchers, will ask you to analyze the impact of that error on everything else. This is where you score the big points.
And this table shows that domino effect perfectly. Let's walk through it. So, if you understated depreciation, your expenses were too low, which means your net profit was overstated. Simple enough. But depreciation is a non-cash expense, so it actually has no effect on working capital. See the nuance? Now, let's say you forgot an accrued expense. Your profit is overstated and your current liabilities are understated, which means your working capital is also overstated. Understanding these cause and effect chains is absolutely crucial. Okay, take a deep breath. We've gone through a ton of info, so now it's time for the ultimate study hack. This is the slide you want to burn into your memory. This is your high-yield, no-fluff summary for exam day.
Let's do a rapid-fire review. What's the rulebook? PAS 8. What's the fix called? A prior period adjustment. Where does the journal entry go? Beginning balance of retained earnings. What's the most important detail? It's net of tax. How do we apply it? Retrospective restatement. What are the two types of errors? Counterbalancing and non-counterbalancing. And what's the higher level skill? Analyzing the ripple effect. You got this.
So I'll leave you with this final thought. We've spent all this time learning how to fix mistakes, which is great, but the real goal? It's to stop them from ever happening. So now that you have this power, think about your future as a CPA. What's the one error you'll be extra careful to look for to make sure it never gets past you on your watch? Think about it. That's all for now. Good luck with your review.